Welcome to the Deep Dive. Today, we're taking a close look at just one piece of info, actually. It's a Motley Fool article published back on April 23rd, 2025.
Right. And the headline really grabbed us, didn't it?
It did. This 6.5% yielding dividend stock offers income certainty in uncertain times.
Catchy.
So our goal here is to really dig into why this specific article points to Verizon, VZ, as maybe a stable place for income right now, especially with things feeling a bit, uncertain economically.
Exactly. We're focusing just on their arguments, the data they use in the article itself.
Think of it as trying to understand their income certainty claim. It feels particularly relevant if you're maybe looking for more reliable returns, perhaps trying to avoid some of that market volatility we've seen.
Okay, so the article jumps right in. It sets the scene by talking about, current market uncertainty.
Yeah, and it specifically mentions the Trump administration's tariff policy as something that's kind of spooked the markets.
Right, and raised the possibility of a recession. The concern they lay out is pretty standard. Shaky economy, people and businesses cut back spending.
Which can hit company profits and, crucially for income investors, maybe lead to dividend cuts.
But what's interesting is how they immediately pivot. They acknowledge the worries, but then frame Verizon as being different.
Oh, sad.
Their core argument is that Verizon has what they call very durable cash flow. That's the phrase they use.
Yeah, durable cash flow. What's behind that, according to them?
It comes down to the services. Wireless broadband, the things consumers and businesses really rely on day to day.
Essential stuff, basically.
Pretty much. Stuff people tend to keep paying for, even when they're cutting back elsewhere. That creates recurring revenue.
Right, that makes sense. Did they put any numbers on that?
They did. They mentioned Verizon's Q1 2025 results. Total revenue was $33.5 billion.
It was up, wasn't it?
Yeah, up 1.5% year over year. And they specifically highlighted wireless service revenue, $20.8 billion, which grew even faster, 2.7%.
So it suggests the core business is still growing, not just treading water.
Exactly. And then they get into profitability and cash generation. This is key to their argument.
Okay.
Cash flow from operations in Q1 was $7.8 billion. That's up $700 million from the year before.
$7.8 billion. And what did they do with that cash?
Well, that's the crucial part. It covered their capital expenses,
Yeah.
Network upgrades, maintenance, that sort of thing.
How much was that?
$4.1 billion. And it also covered their dividend payments, which were $2.9 billion.
So $4.1 billion plus $2.9 billion. That's $7 billion. They brought in $7.8 billion.
Right. So they had $700 million left over, what the article calls excess free cash flow.
And was that just a one-off or?
No, they point out it's a trend. They generated, I think it was $8.6 billion in excess free cash flow over the whole previous year.
So consistently generating more cash than needed for operations and dividends.
That seems to be the picture they're painting. And they talk about what Verizon's doing with that extra cash, too. Strengthening the balance sheet. They mentioned the leverage ratio was down to 2.3 times at the end of Q1.
Down from what?
From 2.6 times the year before. So an improvement.
And for listeners, lower leverage basically means less debt relative to earnings, right? A stronger financial footing.
Generally, yes. It suggests less risk. And to back that up, the article also mentions their strong bond ratings A, BBB+, BA1. Think of it like a good credit score for the company.
Got it. Okay, let's talk dividends, because that's in the headline. 6.5% yield. That's pretty substantial.
It is. And the article emphasizes not just the yield now, but the history. They've increased the dividend for 18 consecutive years.
18 years. That's quite a streak.
It is. And they make sure to point out that this streak includes 2 pretty severe recessions.
Showing resilience, then.
That's the implication. They also state it's the longest current dividend growth streak in the U.S. telecom sector.
Wow. Okay. So what about the future? Does the article give any guidance on whether this can continue?
It does touch on Verizon's own expectations for 2025. They anticipate 2 to 2.8% growth in total wireless service revenue.
Okay.
And adjusted earnings per share growth up to 3%. And importantly, they project strong free cash flow, again, somewhere between $17.5 billion and $18.5 billion.
After capital spending?
Correct, after capital spending.
And how does that stack up against the dividend cost?
Well, the article states the current annual dividend payout is about $11.6 billion.
So $11.6 billion in dividends versus potentially $70.5 billion or more in free cash flow.
Exactly. That's what the article calls a big cushion. It suggests the dividend is, pretty well covered.
Okay. Makes sense. Now, they also mentioned an acquisition, didn't they? Frontier.
Briefly, yes.
Yeah.
A $20 billion all-cash deal expected to close next year,
And the goal there?
primarily to boost Verizon's fiber network. Fiber is key for high-speed internet and, well, future tech.
Any other benefits mentioned?
They project at least $500 million in annual cost savings from the deal eventually. But they also note the 2025 guidance we just talked about doesn't include any impact from this yet.
Right, that's still pending. Okay, let's loop back to the risks mentioned at the start. Tariffs, recession fears. How does the article think Verizon handles those?
On tariffs, the argument is that the direct impact shouldn't be huge. Verizon doesn't rely heavily on imports or exports for its main business.
So, somewhat insulated?
Directly? Perhaps. But they do acknowledge an indirect risk.
Which is?
If tariffs fuel inflation or if there's a recession, some consumers might get more price sensitive, Maybe look for cheaper mobile plans.
So potential for some customers to switch.
That's the potential indirect effect they mentioned, yes.
And is Verizon doing anything to sort of counter that possibility?
Well, the article points to their big investments in upgrading the network, 5G, fiber. The idea is that offering a faster, better service helps keep customers loyal, even if cheaper options pop up.
So relying on network quality as a retention tool.
Seems to be the strategy highlighted.
Okay, so pulling it all together, the article seems quite confident in Verizon's stability. They use phrases like fairly recession-resistant and proven its durability.
Yeah, the core argument really circles back to the essential nature of the service. Communications, internet access. People tend to prioritize these even in tough times. It gives them a base level of demand.
Right. Less cyclical than maybe some other industries.
That's the idea. So to just quickly recap the article's main points for positioning Verizon as an income safe haven.
Go for it.
Okay, first, that durable cash flow from essential services. Second, strong financials, good profits, plenty of free cash flow covering the dividend with room to spare. And third, that improving balance sheet, lower leverage.
And all that together makes the 6.5% yield look pretty secure in their view.
That's the conclusion they draw, especially considering the broader economic uncertainty.
So, for you, the listener, the main thing to take away from this specific Motley Fool piece is their argument that Verizon offers a significant dividend, seemingly backed by a steady business, even now. If stable income is high on your list, their analysis suggests it's worth a look.
Absolutely. But it also brings up a thought to maybe chew on after this. This article gives a positive snapshot based on today's data, April 2025. But, how might really big technological shifts, things we can't foresee, or major changes in how we all use this tech, how might that affect even a giant like Verizon long term?
Good question. What factors beyond just tariffs and recessions might you really need to track for true long-run income certainty from any company, even one that looks stable today? Something to think about.